Natural gas prices extended their recovery last week as the market transitioned into the November contract, a period when traders typically begin pricing in winter heating demand. Seasonal patterns are becoming more influential, and expectations of colder weather across the United States and Northern Europe are creating a supportive backdrop for prices. The shift from the October to November contract often marks the start of a stronger demand cycle, and this year appears to be following that trend. European buyers are also expected to increase purchases of U.S. LNG heading into winter, tightening domestic supply and providing additional upward pressure on Henry Hub prices. Since the U.S. continues to play a key role in meeting Europe's energy needs, export growth could help sustain the bullish momentum into the end of the year. However, risks remain. U.S. production continues to operate at elevated levels, and inventories are still comfortably above the 5-year average, which could limit the scale of price gains. A mild winter or weaker than expected demand could trigger a pullback, especially if weather models shift toward warmer trends. Moreover, as warmer than normal weather persists into October, what was once a bullish factor has now turned bearish, adding renewed downward pressure on natural gas prices just as the market heads into the colder season. Keep in mind that the key price driver remains the anticipated increase in LNG exports later this year. However, any further delays in the Golden Pass startup could remove this bullish catalyst and lead to a market pullback. Recent updates suggest that commissioning activities at the Golden Pass facility are progressing, with first LNG production still targeted for late 2025 or early 2026. Analysts say the Golden Pass LNG project is still slated to start service in the first quarter of 2026, despite the owners asking federal regulators for an extension to complete construction of the export facility. That said, the project has already been postponed from its initial schedule in the first half of 2025 to the end of the year or beyond, and this delay has already contributed to a significant price decline from March through August, and there is no guarantee that additional delays will not occur in 2026. If such delays coincide with a warmer than normal winter, the market could face a sharp downturn toward $2.50 or even lower, a scenario that has played out multiple times in the past, reinforcing natural gas's reputation as the widowmaker. From a technical standpoint, natural gas futures rallied sharply last week, testing resistance around the $3.50 level before retreating slightly. The price action reflects healthy buying interest but also the need for a short-term correction after recent gains. Strong support is seen near $3.20 and $3, levels where buyers are likely to re-enter the market if prices dip. A sustained move above $3.50 would signal renewed momentum and could open the door for a test of the $4 region in the coming months. Conversely, a break below $3 would weaken the bullish structure and suggest a deeper pullback before the next leg higher. Overall, the technical setup points to a developing uptrend, with dips likely to attract fresh buying interest as traders position ahead of the winter demand surge. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.